Hello, this is Tom Burrows here, Group Editor at Wealth Briefing, and I'm delighted to be joined by panelists to discuss how should wealth managers embrace digital assets, a topic which is very much in the public mind at the present time for all kinds of reasons, which are both obvious, some less obvious. So I'd like to kick off, if I could introduce my fellow panelists, please, and ask them to introduce themselves and tell us a bit about what they do, and then we can get stuck into what is going to be a very interesting hour. During the course of this, we'll be taking questions, and I hope you make use of the chat function to do that. And we can take some of these questions during and also towards the end of the session. So without more ado, can I just take it with Andrew at the start? Introduce yourself.
Thank you, Tom. Hello, my name is Andrew Dean. I'm Head of Business Development for Wealth Briefing and Wealth Briefing Asia. I had a lot of interest around the digital assets, cryptocurrency market over the last couple of years, and chaired our panel on this yesterday, looking at Asia. Thank you.
Thank you. Anatoly.
Hi, my name is Anatoly. I'm co-founder and CEO of Nickel Digital Asset Management. We're a London-based investment manager focusing on digital assets and offering various access points to crypto market, starting from market neutral arbitrage to directional exposure to this asset class. Thank you.
Thank you. Benedict.
Yes, thank you very much. My name is Benedict. I'm working for Julius Baer, a global wealth management company based in Switzerland. I am responsible, next to other things, for our digital assets offering. And further to that, I'm chairing the working group Digital Assets of the Swiss Banking Association.
Thank you. And as I said, I'm Tom Burrows. I'm the Group Editor of Wealth Briefing, colleague of Andrew's, and I'm in charge of the editorial files. And certainly that the digital asset agenda has been very much something that we've been writing about and will continue to write about in the future. So as you can see from the title, we're looking at how should wealth managers get to grips with digital assets such as Bitcoin. So the obvious place to start, I feel, is to get some definitions locked down. So what is Bitcoin? How is the best way to understand what it is and how it's come to be? So maybe if I should direct that one really to Anatoly. So tell us, what is Bitcoin?
Sure. I regard Bitcoin as a synthetic, non-discretionary asset with transparent and immutable monetary policy. And I'm very happy to unfold this. Synthetic because it was invented 12 years ago. Non-discretionary because no entity or individuum has the right to change the underlying issuance schedule or the number of coins ever in circulation. And that's what we are discussing, monetary policy. That monetary policy is extremely predictable and immutable because of this inability of any entity to influence that monetary policy. And that's exactly what came to prominence over the last 12 months, because with the money coming from the central banks as the economic stimulus in the COVID times, that triggered concerns, very varied concerns, to potential monetary debasement and inflationary impact. And many, at first, hedge fund managers, and then it spread to corporate world, this search for hedge against this monetary debasement and against inflation. We'll discuss it later in the presentation, but it's important from my point of view to differentiate between cryptocurrencies and crypto assets. It's generally everything is called cryptocurrencies, and that may be actually confusing for the simple reason currency implies an efficient mean of exchange, which is not necessarily the case with Bitcoin. I can tell you Bitcoin is not very efficient in that manner, in that sense, because the number of transactions is limited to 3 to 7 transactions per second. You look at a very old technology, Visa International, dated 1970, Visa International can process 56,000 transactions per second. Of course, Bitcoin cannot compete, but it doesn't have to compete on the throughput. What Bitcoin has to compete and deliver actually, it's store of value function. And that's where its value comes from, because there is a scarcity element embedded in Bitcoin. And as we know, the only reason gold is worth anything is scarcity, really. Because if you were to discover a new gold mine and unintentionally would disclose to the world that the volume of gold we've just discovered is 5 times what we have over the ground, well, we all know what's going to happen to the price. Price is going to collapse immediately because the element of scarcity is lost. That's exactly what Bitcoin brings to the world in a very transparent and easily verifiable manner. There is only certain number, 21 million, as we know, ever to be in existence. And certain number of them already issued. The remaining, we have a very clear schedule how it's going to be issued. And that's what creates store of value function. Thank you.
Does anyone else want to come in about how they perceive what Bitcoin is?
Well, maybe I can add to that, at least from what we see in private banking now in Switzerland, and I guess that's the fact from all over the world, is like the increasing institutional adoption. I guess there's not a day where not a big name is announcing investing such and such amount into crypto. I'm not yet decided if it's a good thing in the end or in the long term. Certainly it helps in the institutional adoption, whether tweeting about it, how much you invested and how much you didn't invest, if you like Bitcoin more than Dogecoin, anything related to that. That's obviously another question to be asked. But from a Swiss perspective or from a private bank perspective, that's something that you cannot ignore, right? Anatoly mentioned it briefly in the beginning or previously. There's an article in the Financial Times that obviously there's a tipping point where we're more at the risk of not being invested or not taking care of things regarding Bitcoin is higher than actually being invested in Bitcoin. And that's also something that we feel.
Yeah, I think that there was this element that a few years back, it was a career risk of getting Bitcoin in your portfolio if you're an investment manager. Today, career risk is not paying enough attention and actually kind of giving enough consideration to this new asset class.
It's interesting what you just said, Anatoly, because I remember a few years ago when I think it was Jamie Dimon, the still CEO of JP Morgan, was reported to have said that he would fire anyone on his payroll who was involved. I suspect, well, we know stories are breaking all the time, that's a very different story. And what the FT said is very interesting, that you can't afford not to be in it, as opposed to you should take a different approach. So that neatly segues us into our second main question, which is we're seeing more of the mainstreaming of digital assets. And that term has been used, including on our own website, several times. And we're seeing a number of very large financial institutions, and you've just popped that up on the page so that people can see about what's going on. So can we just talk a bit about how this is becoming more mainstream? What level of progress has already been achieved, and what needs to still happen for it to continue on this path? So maybe Anatoly, if you want to pick that up, and then Benedict.
Sure. I think it's fair to say that 2020 became a pivotal year in the history of digital assets, to the extent that FT, generally being at best neutral, possibly slightly negative towards crypto over the years, in 2020, in December, they had to acknowledge that 2020 is the year when Bitcoin went institutional. And interesting, the background story was really, as we discussed, this kind of money printing at the unprecedented levels. And by the way, if you look, this is McKinsey report dated mid-2020, and it's kind of graphically shows what is the size of economic stimulus. So in 2008 financial crisis, let's take the example of Germany. Only 3% of GDP was kind of offered to the economy as economic stimulus. In 2020, in response to COVID, it was 33% of GDP. And that gives you a feel of dimension of this monetary stimulus. Now, that triggered interest from many people who are in the business of protecting investors' capital. And certainly wealth management is part of that industry, really kind of we are holding clients' capital. And Paul Tudor Jones, to me, was perhaps instrumental in changing the mindset. Back in May 2020, he came up with a piece of research called the Great Monetary Inflation, essentially discussing how this money printing may trigger the inflation. And he went through possible hedges. And of course, amongst those hedges, you had gold, you had real estate, equities, certainly with one caveat: they are overpriced, and certainly valuations are stretched. And suddenly, to his own amusement, he discovered Bitcoin as one of the inflationary hedge. And he took a position and brought this argument to the wider world. And that was picked up by many other people. So Stanley Druckenmiller, Bill Miller, this is very big names in the hedge fund world. They also took position in crypto. And then there was a turn for the corporate world. So MicroStrategy came up with 450 million allocation, 425 million allocation in August, which subsequently was topped to 2.5 billion by February this year. And that what created this initial interest from other corporates. And then you have Tesla, most recent example. But more importantly, banks who, as you mentioned, JP Morgan, who was for years quite negative towards crypto, suddenly came up with a far more constructive view, again triggered by this inflationary element. And first JP Morgan back in October said, well, given how efficiently Bitcoin competes with gold, we have to admit there is a value in kind of on the level of Bitcoin. And our view that the fair price would perhaps be 3x from where Bitcoin is today. Mind, that was back in October when Bitcoin was at 15,000. And suddenly JP Morgan names 45,000, which was completely unexpected and something like sounded, is it really possible for a bank to give that sort of guidance? Guess what? In early January 2021, JP Morgan had to revise this guidance from 45,000, because market already reached that level, to 146,000. And then there is certainly not shortage of other guidances out there. But what I'm saying that there is now a widespread acceptance of this asset class. More importantly, very constructive views. And you have Ruffer, UK-based asset manager. You have Guggenheim Partners, a massive New York-based asset manager. Every one of them is taking a constructive view and adds this to the portfolio. And that what created 2020 such a kind of sea change in digital assets world. Benedict, over to you.
Benedict, yes, please. I'd be interested to hear what you have to say on this.
Well, it certainly helps that people are taking a look at things more seriously. It's not long ago that you would hear something like, well, Bitcoin is kind of a nerd money. It's only used in the darknet to buy drugs, which is probably still the case, we have to admit, then to a far lesser extent that people always think it is. Actually, it's quite lower than for example, US dollar plays a much bigger role in illicit activity than Bitcoin does. But what we have seen in Switzerland, that's also what we see, that's basically part of the reason why the working group of digital assets has been introduced at the Swiss Banking Association, is that people are taking a more serious look at things, trying to understand the rationale behind it, the implications, not only of Bitcoin itself, which is, for whatever reasons that I cannot tell you, still the most popular cryptocurrency, because there are far better ones already out there. But people are starting to take a look more serious at things, trying to understand, trying how to implement that in the corporate strategies. I mean, you mentioned many examples from Tesla, Guggenheim, and all those names, and that certainly helps. However, there's still, at least to what we see, there are some obstacles still to be taken in order to, let's say, pave the way having digital asset in a ordinary portfolio. I think we are still a fairly reasonable distance away from having digital assets being a part of a, let's say, balanced portfolio. I think we're not there yet. Yeah.
But I think a lot of that is down to, I think a lot of that's potentially down to education of the market. And as you said, Benedict, the historical, if you like, damaging discussion around this is whether it's linked to crime or it's linked to money laundering on the dark web, whatever. And it's like everything else, really. It's about educating the market that has now changed and why that has changed. And I think that's crucial to really the way that it can go forward.
Mm-hmm. Well, that's actually one of the most important points that we have identified, not only within the area that I'm responsible for, also in the Swiss Banking Association, is the topic around education, right? I mean, the whole world, most of the world has heard about Bitcoin, and I guess it's a fairly little extent to that people who can actually really explain and understand how and what Bitcoin is and how it works. However, it's not that complicated. I often see when I have discussions, people try to make it look very, very difficult, but in the end, or in a nutshell, it's very simple. It's similar to how a car works, for example. It doesn't take a lot to understand how an engine works, for example. If you want to build your own engine, then things are definitely different, right? Mm-hmm. But the same with Bitcoin. It doesn't take a lot to understand it. It definitely does. Some efforts need to be taken in that, but honestly, it's not rocket science, even though others might make it look like rocket science.
But you would have to admit that the way Bitcoin is designed, somebody compared it to the Sistine Chapel, the beauty of this design. And interesting, it has been around for 12 years, right? It was launched in January 2009. And yet this machine runs incredibly smoothly. If you think of Microsoft Windows, these guys have to patch your Microsoft every 3 months to keep it alive. Well, Bitcoin has been around in the public space for 12 years. And certainly the bounty of hacking Bitcoin is incredible. You can see these accounts holding millions, sometimes billions of dollars. And yet the system is so resilient. Because whenever we make the press screams around about hacking, we have to differentiate two levels. Level one, the protocol itself was never successfully hacked. What is being hacked is really kind of layer two, user end. How do you hold your private key? And that's where we have to think about private key management structure, which again, problem which is already solved. But it's important that fundamentally the beauty of this concept is incredible. That was actually my personal story, because when I was with Goldman's in 2017, that's where the clients started to come with the question, hey, are we missing something? Do we have to be exposed to this, if you can call it a new asset class? And I have to admit that as many of us, I had been rebuffing the whole idea of crypto for years. But back in 17, I've just immersed myself in the whole concept just to be able to talk to clients in some constructive manner. And that's why I came to appreciate the mathematical beauty of blockchain. So in my personal case, I went back to Oxford, did a course with called Oxford Blockchain Strategy course. And it's a joint venture of MIT. MIT gives you underlying technology. Oxford forces you to think how it may impact your business, in my case, banking, or what potential new opportunity it creates. In my case, it was a point of no return. When I decided to leave banking, traditional banking, in order to build something from the scratch, but really addressing this new evolution of the way I see the financial world. It's certainly a very small part of the financial world, but perhaps the fastest growing and will remain such for the foreseeable future.
Tom, I noticed we've had some pretty good questions come in. What do you want to answer?
Yeah, I'm going to suggest I take a couple of them and throw them to you guys to answer, and we'll obviously harvest some of the others towards the end. So anybody who submitted a question, if I don't pick it out, don't hate me. We will try and get to them towards the end. But there's a question I've got here from Daniel Martineau. Hello, Daniel. I hope you're doing well. Says, maintenance of the infrastructure is through miners who are rewarded by coins, what happens when the limit of 21 million is reached? Anatoly, can you answer that?
Sure. So the miners' economics today consist of two parts. A is the new coins which are released by the system to successful miners. We will not go into that, but that's basically your battle of hashing power. Who closes the block? Whoever successfully closes a given block gets 6.25 Bitcoins. Now, so this is the first reward. The second part is really transaction fees, which miners also charge for every single transactions going through the network. At some stage, 120 years from now, Bitcoin network will stop issuing new coins. That's the point where we reach this 21 million coins in circulation. And perhaps I want to show this slide. That's how the issuance works in Bitcoin network. As of today, we're 89% of all coins issued already in circulation, and the balance of 11% will be issued over the next 120 years. But at some stage, as we said, the new coins will not be coming in circulation. However, the second component, which is processing fee, they will remain in place. As a matter of fact, they will become the only source of revenue for miners. Some miners may be willing to leave the system by then because it may be not sufficient for them to engage in terms of reward or a revenue stream. But certainly there will be miners who would be willing to carry on maintaining this system.
I've got a second question, and it's one that I think we anticipated would come up. It's from Wendy Spires. Crypto dovetails with other huge investment theme of our time, ESG, in that crypto mining is generally held to be terrible for the environment. Whether that's true or not, I don't know. How can investors reconcile these two? Anyone want to pick that one?
Yeah, maybe I can just share some light on that. And that's also a topic that we broadly discussed within a bank. How could we advertise, or how could we advise our clients to invest in, for example, Bitcoin, if we know that from an environmental perspective, it is clearly one of the worst things that you can do, right? And obviously, those two do not go together. It's as simple as that. If you are investing in an ESG friendly way, then obviously there's no room for Bitcoin in that, right? The good news is that Bitcoin is not the only cryptocurrency. It's by far the most popular. It's the biggest still today, with all its flaws that we see today, that we know of. I guess the recent figure that I have seen is that the whole Bitcoin network uses as much power as Argentina, right? It's one of the biggest countries out there. And you have to imagine, and there's clearly no other way to call that out. That's probably unsustainable, right? If not using the word insane, right? But there are other coins, other cryptocurrencies out there. They're already there. They're already, let's call them better proven, right? They haven't been issued yesterday. For example, the second largest cryptocurrency, which is Ethereum, actually is on its way from changing its consensus algorithm mechanism from proof of work. That is what Bitcoin does, right? That's the enormous power that needs to be invested. All those machines plugged together, trying to create the next block. They are moving from that consensus mechanism to proof of stake, which is a much more environmental friendly way to find consensus, to create blocks, and so on. And there are multiple other cryptocurrencies out there, none of them being as prominent as Bitcoin. That's basically, the whole world talks about it, but they are already out there. You just have to look for them.
Mm-hmm.
And that once again goes back to what we said earlier, didn't it, about education of the market? That it's not just, the Bitcoin does have that implication about ESG, but there are other Bitcoins out there which don't have the same damage.
Mm-hmm. I would like to add to this point, because I had this question posed in one of the conversations with a large financial institution recently. ESG angle is certainly very important, but we have to unpack these questions for two components. First, whether the system needs this energy spent, as you mentioned, the size of Argentina, right? Energy consumed. The answer is system does not require that. Actually, Bitcoin network would be perfectly fine with 1/10 of this energy committed to the network. The only reason we are where we are, it's an invisible hand of the market, because there is economic incentive for private players to come and participate in this network, and that drives the energy consumption. But the system itself is not hungry for this energy. So that's the first thing. Second is what type of energy is being consumed within Bitcoin network. And the recent study by Cambridge Center for Alternative Finance indicates that actually as much as 76% of miners are relying on green energy, on renewable energy, rather than coal burning or other source of conventional types. And even if we look on China, China is the biggest contributor to hashing power. Roughly 65% of all mining activities are done in China. If you look on the map of the country, it's concentrated pretty much in a couple of provinces, which historically had overbuilt number of these dams, right? The hydropower. And you would appreciate that exporting these to the other end of the country is rather an expensive way. Energy does not travel well. It has to be consumed relatively locally. That's where the miners suddenly discovered ability to place their equipment very close to these hydropower stations and offtake it from them. So this is the first thing. Next evolution is very interesting. Now miners are searching for cheaper sources of energy, and that's an important thing for them because within their P&L, there are two large sources of expense. One is CapEx, buying equipment itself, and second, even more important, is OpEx, how much energy they have to spend. And actually, the cost of electricity is of paramount importance for them to stay alive and competitive in the long run. That drives them going into the cheapest possible source. And unexpectedly, Iceland emerged as one of those centers. Why? Because of the geothermal energy. And exporting electricity from Iceland to mainland Europe is impossible, right? Because there is no real line you can build, but you can consume it locally, and that's where the miners suddenly found this ecosystem with the geothermal sources in Iceland. Another one is a flare gas. So you would have these oil extraction units. In Texas is a very large center for that, where the oil is being extracted, but the side effect of flare gas essentially is thrown in atmosphere. Question, why not take it in the pipeline and use for the gas kind of supply of the economy? The answer is it's economically non-feasible because the oil extract units, they are mobile, they are moving. You cannot build pipeline to each of them, which implies it's pretty much burnt out. And what miners discovered, they can bring their equipment. And actually on that slide, you would see this is the flare gas in Texas. These units are containers full of mining equipment, which can be stationed next to the burning gas. Just they would offtake gas, convert it into electricity immediately, feed it in the machine. The only thing they need now, internet connection. And using satellite, that's how they connect to the internet. And it becomes very interesting balance. So there is more and more energy consumed in the green form rather than burning coal or oil.
Interesting.
And I would add to that if you look on the history of Bitcoin, when it emerged 12 years ago, there was a completely different agenda. It was a survivorship agenda. Can you survive in a very hostile world when you have an open source protocol open to the world, right? And you have brothers in arms, other software developers, hackers who are trying to hack into your system. You have hostile governments around the world who are trying to, basically, they would love to see you dead rather than alive, right? Because you are creating a competing monetary system. From that perspective, security was of paramount importance rather than green energy angle. But 12 years down the road, Bitcoin has proven its ability to survive and actually getting stronger year by year. Now the green angle becomes more relevant, and I can see how the whole system migrates toward greener use of energy. And ultimately, it's possible even the proof of stake, the concept mentioned by Benedict, which Bitcoin in theory can migrate at some stage.
Well, that's very, very good. We've got some more questions coming in, but I'm going to just park those for the moment because I want to get on to the next main one that we were scheduled to address, which is about, it relates to Switzerland. A country which is obviously very experienced in and around financial matters. And the question really is that how does the Swiss market think about these digital assets, and what part can it play, should it play in a sense of reinventing or taking Swiss banking to a new place, given all the things that have happened over the last few years? So Benedict, can you just give me some steer about how this fits into the Swiss banking agenda, and tell us a bit about the work that's going on in that space? Thank you.
Mm-hmm. Yeah, of course. Well, what we mentioned in the beginning, right? These increasing institutional adoption, which is accelerating actually at a very fast pace in the last few months and weeks, let's say. Actually, I don't think Switzerland is in the need of reinventing itself as a financial marketplace. There's always been, let's say, some a quality that has been added from a Swiss perspective. And now that let's call it the whole digital assets market, not only relating to Bitcoin and other cryptocurrencies, but everything that is going on in the world of digital assets, also covering tokenized shares, tokenized equity, maybe tokenized art collection, let's sum that all up. And that is probably to an extent now at a size where I'd say, okay, now it has become a reasonable size. The institutional investors are asking for it. It's not only, let's say, retail investors trying to make a quick buck out of it, right? Now we have institutional demand that gives us the confidence that it's also, let's say, justified having some investments done in that, not only by building up partnerships or getting two banks like SEBA and Signum being digital assets banks as such, right? Having a banking license, basically focusing on crypto-related services only. So we see there's a demand that is worth taking note of and worth offering them solutions, right? And it's not as such being probably the question of should you buy Bitcoin rather than Ether. I don't think that's probably what our clients are looking for. The majority of clients, they are looking for a institutional way of investing in things, right? Because everybody can just swipe his credit card, buy some Bitcoins online, and that's basically off you go, right? I mean, setting up a Bitcoin wallet is a matter of seconds nowadays. You just go on any website on the internet, you can do that, but it's not in a framework where an institution can interact with, right? So you would need let's call it a proper partner on the other side of the table that needs or that is able to take care of things. And these are very simple things, right? Just having a bank statement showing you own 100 Bitcoin, that makes a huge difference than showing somebody, I don't know, BitInfo charts or on Blockchain Explorer online. Hey, that's my wallet. There are my 100 Bitcoins. I'm the owner of that. That's a completely different angle if you are able to show that on a bank statement, right? You're on mute.
Tom, you are muted. Yeah.
Bad rule. Anatoly, what do you take about what's your observation from how things look to be working in Switzerland, given your own experience?
Yes, I'm glad that the perception of this sector or this asset class is changing from pure speculation, which, let's be honest, it has been for years, into more allocation rather than speculation. And that has been the message we've been giving to our clients, that there is a place of digital assets in an institutional portfolio or in private wealth portfolio, because there is a positive impact on both top line and risk framework of such a portfolio when you include digital assets. And I'm going to share one slide which I found particularly impactful. It is right here. So we've done our homework by looking at the last 8 years from December 2012 to December 2020. And the idea was, forget about Bitcoin for the time being. Let's look at the classical 60-40 portfolio used in wealth management world. So 60% S&P 500 for simplicity and 40% US Treasury. So such a portfolio without any crypto for the time being has delivered 124% cumulative return over the last 8 years. Standard deviation is 10% and max drawdown is 21.6, to the large extent defined by S&P correcting massively in March 2020, a year ago, when it went down 34% and dragged the whole portfolio. Now, this is our base case scenario. And from there, we're engaging in the intellectual debate. What if we were to add 1% allocation to Bitcoin? We're going to claw this 1% from equities and throw 1% BTC. Now, what happens that such a portfolio would have delivered, instead of 124, 146%, which is impressive, 22% extra return for just 1% allocation to Bitcoin. But what comes as a completely counterintuitive, that risk profile of that portfolio actually improves. So your standard deviation from 10% goes to 9.95. So slightly lower risk to the portfolio. And max drawdown actually slightly improves from 21.6, now it's 21.5. Question, how on earth you're adding a very volatile asset class and yet your risk framework improves? And the answer is very uncorrelated nature of this asset class. And to that end, if you look on S&P 500 for the last 10 years, and on this graph, we have collected all S&P drawdowns. The orange bars is how S&P was selling off anything like 5% and over. And we superimposed what Bitcoin did over the same period of time, day to day, right? Kind of from the highest point of S&P to the lowest. And an example, in April 2011, S&P was down 19%. Famous tantrum when Fed was considering increasing interest rates. So S&P is minus 19%. What Bitcoin does over the same period of time? Well, Bitcoin did not realize there was a market sell-off and went completely different direction and actually delivered plus 76%. Well, we look at April 2012, very similar picture. S&P minus 10, Bitcoin plus 6, and so on. Of course, you have times when both Bitcoin and S&P in unison go in a sell-off. The most recent example would be March last year, when both sold off by 30%. But you can see still there is generally a very independent behavioral pattern of Bitcoin versus S&P 500. And that's exactly the uncorrelated source of return you would like to own as an investment manager, right? And coming back to our table, that improves your overall portfolio diversification. It shifts up efficient frontier of the portfolio and adds not only on the top line, which would be expected, but also improves risk characteristics. And then if you go in a more kind of adventurous implementation, say, okay, what would be if we add 3% Bitcoin in the portfolio? Well, 3% allocation would have increased a return from 124 to 196, which is a solid 72% improvement. For the risk, which is just goes up from 10 to 10.05. I'm very happy to take 5 bips of extra risk for 72% extra return. That's what I'm saying. It's kind of, there is asymmetry of return to this asset. Your downside, specifically when you allocate 1 or 3%, your downside is very understandable. The maximum you can lose 1% if the whole crypto market goes down the drain, which I think we don't share this view at this stage. But on the same, at the same time, the upside potential is disproportionately large by even small allocation to crypto. That's the logic behind kind of a structural allocation to this asset class in what I would say very kind of controlled manner, rather than let's sell house, buy Bitcoin. That would be rational. Allocation 3% makes perfect sense.
I think what you've done there, Anatoly, is partly anticipate the next question I was going to ask, but I think we are going to repeat it anyway, which is, that leads us to the question, how should these assets fit into clients' portfolios, and what sort of conversations should wealth managers really be having with their clients? We've kind of like already touched on the fact that the attitude now seems to be you can't afford not to be in it anymore. Can we just expand, however, on how you think this should sit inside a portfolio? Just adding a little bit to the points you've just made, Anatoly, and then Benedict.
So Benedict, would like to take? I'm happy to proceed.
Yes, please.
Yeah. Okay. So the way I look at Bitcoin, and by the way, we have to differentiate between Bitcoin and altcoins. And I'm not a Bitcoin maximalist by any stretch, but I see a different function of Bitcoin and other crypto assets. First, Bitcoin has pretty much solidified its leadership position as a store of value. And that's where the fundamental value proposition lies in Bitcoin. Whilst altcoins, and we can touch on that later, offer completely different value. It's really bet on technology, on smart contract ecosystem, and so on. But back to Bitcoin. I think the way people should look at that is really driven by its ability to preserve value over time. And with your permission, I will go back to macro picture. And I think it's important really to point out these numbers. So what you see on the screen, it's a M2 money stock in the US over the last 12 months. What has happened that the number of money supply in the US has increased from 15 trillion to nearly 20 trillion. It's absolute increase of 28%. And that's exactly what we are talking about when we make a reference to the currency debasement, which is unfolding out there. And how can you protect your wealth? And one of the questions, like, how big is 28%? How large is this boost in monetary supply? And the answer is the last time that happened was nearly 80 years ago. And on that graph, you can see that anything of that sort of 27% happened in 1943, which in the US was time of World War II economic stimulus by US government. And of course, what they did, they pumped liquidity in the economy to kind of boost economic production. Now, the question is, what happened subsequently in the immediate vicinity around 1943? And the answer is, in 1943, inflation was perfectly under control. It was at 3%. In 1944, it was at 2%. 1945, still at 2%. Comes 1946, and inflation goes through the roof. And inflation in that year was 18%. What happened essentially, that post-war recovery of consumer demand now superimposed over excess liquidity in the economy caused this massive spike in inflation. And that's the risk we are running these days, right? And one of the questions is like, hey, certainly a Fed would be able to kind of, take away the excess liquidity from the market whenever the inflationary pressure emerges. But I wouldn't be that certain because what we are seeing now is more and more conversation about yield curve control by monetary authorities. What it implies that from the prospect of US government, which accumulated massive amount of debt, they cannot afford interest rate to go back to 5%, let alone 10%. They need to have them anchored at 0.5%. Otherwise, the debt load becomes unsustainable. How do you do that? Via interest curve or via yield curve control, which means whenever inflation started to trickle in the economy, they might be in position not to react to that because they cannot afford a rise interest rate. And that's what creates this risk of potential inflation. And from here, exactly as we discussed, coming back to the monetary policy embedded in Bitcoin, there is a limited supply. And that what creates this store of value function, right? And to my mind, Bitcoin should belong within your hedges against this monetary debasement and against this inflation, part of your, if you will, wealth preservation. However volatile it is, small allocation plays significant role in protecting wealth in a long run, at least. Certainly, it will remain volatile in the interim, in the foreseeable future, and that's perfectly fine because where volatility comes from in the context of Bitcoin, and perhaps it's worth stopping here for a second, because in our conversation with many clients, the question of volatility is prevalent, right? I would like to take a view, but I'm uneasy with this volatility. And the answer is there are a few things. A, Bitcoin is likely to remain volatile for the foreseeable future. But interestingly, this volatility may be upside volatility. And the reason for that is this balance between supply and demand. So on the supply side, we have a very strict number of coins to be issued per block. And this is, as of today, defined as 6.25 coins per block. Whatever is the demand on the other side, coming from investment managers, corporates, wealth managers, private individuals, if this demand goes 3x tomorrow, the number of coins issued in circulation is still 6.25. Demand can go 10x, it's still going to be 6.25. which means you have this completely inelastic system, inelastic supply. And that means that from as demand grows and supply remains the same, the only balancing factor happened to be price. And price, for that reason, reacts so acutely to all the inflow of capital. When Tesla comes and buy $1.5 billion worth of Bitcoin, certainly that has impact on the price. And more corporates coming this way, they will push the price up. So volatility will remain there because of the structure. Another thing which defines volatility is size of the pool, right? And here the good analogy would be, if you take a cannonball and drop it in the swimming pool, the ripples from that will be pretty significant. If you drop the same cannonball in the ocean, the guy on the other side of the ocean will never feel that, because size of the pool matters. And that's exactly what's going to happen with Bitcoin. We just recently crossed 1 trillion market capitalization, which is a milestone in Bitcoin development, but it's still kind of very small compared to other asset classes. The closest one would be gold with 10 trillion. And then you have equities with nearly 90 trillion. Then you have fixed income well over 150 trillion, which means Bitcoin is really small compared to these asset classes. And that's why when we have this 2-3% reallocation in Bitcoin, it will react by price fluctuations. But as it becomes bigger and started to compete with gold at the same level of 10 trillion at some stage, of course, its sensitivity to inflow will diminish, and that will create different dynamics on the volatility front. All right, that's a long answer.
Yeah. Let me just unmute myself again. If I could just quickly cut in, because I'm conscious of the time, but we've got one or two questions which sort of segue nicely into that. Sanjoy Sanyal has asked, will the private wealth community advocate their clients accessing digital assets via equity holdings, digital asset funds, or investing in digital assets like Bitcoin directly? Maybe Benedict, would you like to just have a couple of comments on that? And
I can definitely comment on that, and also ties in to what Anatoly just briefly mentioned. First of all, I think it's probably true to the fact that you can take a look at Bitcoin or cryptocurrencies as such from two angles. One of them being a very volatile asset, so it's good for becoming an instant billionaire if you're willing to take the risk. But I guess the better view on things would having taking a look at cryptocurrencies, Bitcoin and such in a portfolio context, and that is what it's all about. I mean, Anatoly nicely pointed out that just a 1% allocation would tremendously increase KPIs on a traditional investor portfolio on the long term, right? So focusing on that, I think there's an imminent need in embedding digital assets as such in traditional portfolio context, with all the steps that are still necessary to go, like education. We have things on compliance, regulatory. The regulatory environment, at least in Switzerland, is very crypto friendly. I would call it like that, but there's still a couple of steps necessary until this is fully embedded. Even though the recently DLT law has been come into effect, it will take some time until banks are picking up on that. If internal processes, guidelines, systems, or what you need to adjust in having that. It's not just simply, I mean, just mentioning a simple example. I mean, we all know that Bitcoin, you can buy one Bitcoin, but you can also buy 1/16 of an Bitcoin. And the technical systems that we are dealing with, at least from a JB perspective, and I'm sure that's true for many other banks, is they know 6 digits behind the comma, but not 16, right? So there's still a gap to be closed, not only in terms of technology, but also in terms of how to embed that into that. And coming back to the question on, I would say I would more answer that in a more general way, not only related to Bitcoin and cryptocurrencies as such. I have to mention the fact that we're not giving any advice. Basically, the offering that we have is on an execution-only basis, meaning if you come to visit us, let's think of JB being a restaurant. You can ask for the menu, and we are showing you what you can invest in, but we are not telling you about the daily specials, right? That would be the situation that we're in. And regardless of talking about cryptocurrencies or digital assets, I would say if you have the chance to invest directly, that's probably in 9 out of 10 cases the better one. Just taking a look at the alternatives. I can tell you, and that's an open secret, and we all know that the Grayscale Bitcoin Trust which is one of the biggest vehicles listed at an exchange that allows institutional and private investors to invest in Bitcoin. Currently, the premium is negative, but on a long term, the premium that investors paid just benefiting from the movement of Bitcoin. I guess the average last year was like at 19%. The average the year before was 26%. We had times where the premium was as high as 100%, giving the underlying value of the Bitcoins. So my take on that would, if you have the chance, you go directly. If you don't have the chance, you go indirectly via, let's say, vehicles that people are already familiar with, be that a structured products and exchange traded products, things like that. Something where you wouldn't have the hassle of dealing with wallets and hot and cold storage and all what comes with it. Then probably go indirect. If you can go direct, then that's probably the best option.
Mm-hmm. Although I would be careful going direct, because that's the philosophy of crypto community, right? Kind of, you are in control of your destiny. You hold your asset. Mm-hmm. However, when we move to fiduciary duties, right, and in terms of custody solution, we're now touching on that point, we have to be mindful as investment managers that we cannot allow for the single point of failure when we are controlling the asset. From my point of view, it should be really engagement of the third-party professional custodians, where you distribute risk of holding private key between few parties. And generally how it's done through the sharding of the underlying private key. So private key is essentially a 64-digit long alphanumerical code. And you can either control it yourself, or you can split it cryptographically in few parts. And then these parts are distributed between, for example, investment manager, custodian, and fund administrator. And then you require these parties to cooperate in order to pull these parts together and recreate master key, which now moves the asset. And that system allows to eliminate this single point of failure risk, when one party can disappear with the asset, which can happen, and history knows that sort of situations.
Tom, do you want to fire away with some of the other questions as well? I think
yes, I will do. Before we get to the last big one, I'm just scrolling back to the top. Paul Dash asked, what about Bitcoin mining and the Bitcoins that it generates? Does that eat into the Bitcoin release schedule? I'm not entirely sure what that means, but maybe Anatoly, can you quickly answer that?
Absolutely. I actually have a slide to that end. So first thing to clarify, the release schedule has no correlation with the mining power, hashing power committed to the network. Same way it doesn't have any correlation with the demand coming from the outside world. So the way system works, there is a thing, as we discussed, per block, there is a certain number of coins which is released by the system. At the outset in 2009, it was 50 coins per block, and each block roughly 10 minutes, right? Now, there is another structure in place called halving. Halving cycle implies that every 4 years, the number of coins released by the system halves. So it used to be 50 coins at the outset, then 4 years later, it became 25. 4 years later, became 12 and a half. And later on, as we live now, it's 6.25. And this slide exactly shows that. So you have a block, 6.25 coins released, and then we move to the next block, and so on. And we know that in 4 years, well, it's 3.5 years from now, in May 2024, it's going to halve again into 3 coins. And that's what creates this disinflationary monetary policy. Actually, with progression of time, the number of coins falls, but it cannot be adjusted or manipulated or really kind of reflect the number of miners out there. No, system releases strictly prescribed number of coins.
Okay. Another question I've got here. Someone quickly asked, how would the emergence of other cryptocurrencies such as Ethereum affect the price?
I'm very happy to take Benedict. Would you like?
Yes, if I may. Well, the thing is, the question that we can ask, or that we should answer, why is Bitcoin so popular as it is today? To make an analogy to the real world, it will be similar like everybody's eating hamburgers from McDonald's and doesn't care about all the hamburgers that are on the market, right? And my take on that would be that first of all, simply they were the first. and it's a little bit a matter of the winner takes it all. And the other one would be probably, you might agree or disagree, but I think the majority of people live in their very own filter bubble. So when you have your, let's say, make a simple example, you have 5 newspapers that you read. You have the Financial Times, you have the Guardian, BBC, whatever. If they do not take any note of any other coin than Bitcoin, and it's actually, I'm in a little bit similar situation, and I did some research on that. I'm a regular reader of the FAZ, Frankfurter Allgemeine. It's a German newspaper. Don't worry about that. It was 2 weeks ago when they, for the first time ever, mentioned Ether being the second biggest cryptocurrency in its own article. It has been mentioned before, but just when they wrote about Bitcoin, they said, yeah, well, there's somebody else like Ether, but it doesn't play a big role. And I would say, coming back to the topic on education, when the crowd, the mass, the people, when they realize, oh, there's something which is, from an ESG perspective, it's much more sustainable. It's much faster. It's not 7 seconds. It's not 7 transactions per second. Maybe transactions are settled in 7 seconds, like in the Ethereum blockchain and so on. There are also a lot of other cryptocurrency, right? I guess currently we're talking about 8,000 different, maybe 9,000. I mean, that number changes every day, and we can for sure say the majority, and you can comment that the majority of these cryptocurrencies is probably crap, right? You can say that, but they are, I would say, a dozen, maybe more than that. Of course, I'm not an expert on all of them. I don't know all of them, but there are certainly other coins with very interesting technological frameworks. I mean, just making an example on Bitcoin. That is my mobile phone. It's a very simple mobile phone. You can do phone calls, you can do SMS. That's it, right? And Bitcoin would be that mobile phone, and Ethereum is like the newest iPhone generation where you can do, I don't know, all sorts of things. That's kind of like to illustrate the technological difference between what Bitcoin is able to do and just the second biggest cryptocurrency. And now answering the question that has emerged up, once the crowd realizes, whenever that's going to be, yes, then definitely things are going to shift.
Okay,
I would like to add.
Anatoly, yeah.
Sorry. Yeah, these are Bitcoin and Ethereum can perfectly coexist in crypto ecosystem because they are serving completely different value propositions. As we discussed, Bitcoin is a store of value. Ethereum is not really a store of value for the simple reason its monetary policy is fundamentally different. Ethereum does not have upper cap. It can go in any number, really reflecting the activity in the underlying of blockchain. Now, what Ethereum delivers is really smart contract platform, and that's the value of Ethereum. They can perfectly live next to each other. Ethereum has a much wider competition because them very sophisticated, I would say, blockchain of the 4th and 5th generation, right, which are competing efficiently with Ethereum. Yet the network effect matters. That's why Bitcoin and Ethereum pretty much jointly control 75% market share. But there is kind of significant competition brewing there. And for us, that's perfect. It's an open space. Everyone is free to deliver its solution. Yep.
I've just got one final question from the chat I want to pick up on, which is, and let's keep this brief because we're nearly at our point here. Someone has asked, how do you see the role of Bitcoin whales as in the large animals of the deep, who have the power to control the price, and is this a concern? I mean, is that something which anyone should get concerned about? Just quickly on that, Anatoly, do you think we should be concerned?
There is certainly a concentration of Bitcoins on it's kind of few thousand larger accounts, right? But I wouldn't be that much concerned because generally the pushback is like, listen, this guy at some stage can manipulate the price by virtue of dumping their Bitcoin. And my immediate reaction to that is like, who you think these people are? Because when you're talking about large holders, look at MicroStrategy. MicroStrategy is one of the largest holders in today's world, $4.5 billion worth of Bitcoin. What is $4.5 billion? This is less than 0.5 percentage point of the entire high market capitalization, and yet everyone we are labeling whales, and we don't know about them, how they escaped unseen, and yet they are controlling now billions. The answer is very simple. They were early adopters, and none of them ever invested billions into Bitcoin. They bought it at a fraction of a cent. That's what it was worth 12 years ago. But they were believers in the system, right? They are it's nearly a religion for them to dump Bitcoin for the sake of fiat currency is something they are very unlikely ever to do. They need to cash out partial their positions, but to the extent to dump it, no, it goes just against their worldview, where Bitcoin is by far more valuable asset than any other fiat currency they may need to escape to. They're not looking for that. Benedict?
Yeah, well, I also see the risk of price manipulation due to wealth as, it is there, we have to say that. Anatoly briefly mentioned that. What I would think is a far bigger risk or a far bigger threat to the overall cryptocurrency market is probably regulation. And just to pick out one recent example is, for example, we know, if you don't know, there's a cryptocurrency called Ripple that has been recently classified by the SEC, the US authorities, as not being a cryptocurrency as such. They classify that as a security, hence they are not in line with the law that is applicable for issuing securities, and that comes with all sorts of problems. We have seen that in the past when the SEC filed against Telegram, the messenger that you probably know. They have, I guess they've raised $1.7 billion in an ICO where they were trying to integrate a token into their messaging system. Story was the same. SEC claimed that's a security. You didn't comply with the law. And the end of the story was that Telegram has had to pay back their investors, right? So if there's, let's say, if there's a bigger threat also in terms of prices, then it's probably regulation. And if you don't play by the rules that are laid out, that I would consider the far bigger risk than whales.
Whales. I agree.
I think I'd be probably better to wrap things up at this point. The one final question I was going to ask is: are we at the base of are we on top of a hill in terms of price, or are we still at the bottom end of a mountain? And Anatoly, you've already said that according by some yardsticks, this thing could go up to $100,000 before we're done. So I think I think what's clear in summary is that this is a big story. It's going to continue developing. But I think we are unfortunately out of time. Thank you to everybody for following this, for your questions.
Can I just make one point? Can I just make one point, Tom? Just to thank everybody involved, and can I just say to Nickel Digital, thank you very much indeed for working with us on this project for both Asia and for Europe and the Middle East. Both webinars have been very constructive. We've had some very good comments already coming through. And Tom, thank you very much for chairing today.
No, you're welcome. And obviously, as I would like to just everyone following this, is that we'll be doing a report on this, and some of the questions that we weren't fortunately able to get to will be captured. And there's going to be a lot more that we'll want to say and write about this in the next few months. And so thanks to everybody for taking part. So have a good rest of the day. Appreciate it. Thank you for taking part.
Nickel is a firm that combines an understanding of digital assets with many years of traditional financial expertise with technology smarts.
Nickel, a group of investment professionals coming from traditional finance, namely JP Morgan, Goldman, Bankers Trust, Deutsche Bank. So combining this experience from the conventional finance and technical expertise, we're pulling these resources together to create a platform via which investors can access digital assets market.
So in order to build a successful manager in the digital asset space, you need three types of expertise. You need experience of trading traditional financial markets. You need experience of trading the nascent digital markets. And on top of that, you need the computer science experience in order to build procedures around your custody and movement of assets, and just to build a trading system that will effectively execute those trades at the exchanges. I think what's unique about us is that at the founding partner level, between the three of us, we cover all three of those. We have 6 years of experience in traditional financial markets. We have 20 years of experience building our trading software. And now we have over 10 years of experience of trading crypto specifically.
The market is ready for custody solutions that have been developed by Nickel. Before, crypto custody was insecure and unreliable. Now, with the solutions that our partners have developed, it's secure, insured, trustworthy. In short, it's ready for institutions.
The market has evolved over the last few years to offer a secure way to access the market. If you think a few years back, people would use what is called self-custody to custody digital assets. We believe that was not really an institutional way to access the market. Today, we have these solutions in place.
The initial investment solution we brought to the market is the Digital Assets Arbitrage Fund. It trades strategies like future spaces, calendar spreads, volatility arbitrage, a whole number of market-neutral, sophisticated strategies. The reason why we began with that was to prove to the market that we can build an effective execution platform where we can easily manage the risks of these sophisticated market-neutral strategies.
We chose to do this first because it's the hardest thing to do. All the other products we can launch after this will be simpler for us to implement. The second product is the Digital Gold Fund. That is a long-only Bitcoin solution that's secure, efficient, and liquid.
Digital gold is a natural extension of the expertise we've gained trading the arbitrage fund. We can execute trades much faster and much cheaper than anybody else in the market, putting us in a very advantageous position to provide this long-only product.
Digital assets are a huge opportunity to transform finance, giving investors access, control and liquidity in a cost-efficient way.
Digital assets is a standalone asset class, like venture capital, private equity. And from that perspective, over time, it will make way into portfolio allocation of pretty much every institutional investor.
I think our goal here at Nickel is to build a one-stop institutional shop for all of your crypto investment needs. We think that the market, as it develops, will provide a lot of democratization of access to different types of instruments out there, be it real estate, be it private equity. We think we will provide the technical solution to trade all of those markets.
So we believe digital assets offer new and exciting chapter of finance, essentially offering greater liquidity, greater transparency, and greater efficiency of financial flows.